Now we begin with the last chapter in this series, which is modeling non-parallel term structure shifts and hedging. The most difficult chapter out of all these chapters. Okay. Now let me start with another page here, which is modeling non-parallel term structure. So as a background, we started when we called out things to be having a parallel movement and a non-parallel movement, a parallel movement and a non-parallel movement. That is where we talked about the twists and the butterflies, and that is what this chapter focuses mostly on, the non-parallel, tracking the non-parallel movement. How do you track for the parallel movement? We talk about the non-parallel movement through duration and convexity, which is already discussed in our last chapter. So this chapter is entirely focused on tracking the non-parallel movement, because the shape can actually be very different. It can either be twist, it can either be butterfly, or it can take a shape of its own. So how do we track that in real sense is what has been discussed here. Now, first of all, the chapter starts with factors and principal component analysis. Now, just to extend your um, discussion from Quant's book and also from your FMP book one, right, where you discussed about these factors, and also from the Quant's book where we discussed around PCA in the machine learning chapters. Now, this is one common thing, that wherever we want to understand the market, we try to find out the factors which are responsible for it. And if there are too many factors, we use the PCA technique to distill it down into a few factors, right? Now, I don't want to work with 1000 factors, so I distill them down into uncorrelated few factors, which I can then use it for regression, right? In a similar way, if I want to understand why and how the bond prices are changing, there are many factors to it. One of the most important factors that go into it is the interest rate change, or what we call it as the yield curve change, interest rate change, or the duration itself. And that is where, if you go back to this one, this is the most important factor of the changes. And that's where, when this chapter started, it talked about a single factor. This is a single factor approach. That means it is the one primary important factor which is leading to the changes in the interest rate and henceforth the changes in the bond prices. However, there are other factors also which are difficult to kind of forecast and predict. With that being said, we come to the principal component analysis approach, where we attribute all of these into different tiers of factors and then start talking about factor scores and similar kind of things that we have done it in a last version as well. So let me open a new book, which will probably help you more to understand the behavior here. Okay, not this one. Okay, here we start talking about factors itself. Now we are saying in our portfolio, which is actually a sum of collection of all the different bonds, we have tried to use some kind of behavior to find out how this will react. So there are four factors. First factor, of course, being the interest rate, which is the majority of the factor. We are saying if we move this interest rate factor by 1%, I'm going to see some changes in my yield curve, which is going to be in the terms of rate maturity, 1 year, 2 year, 3 year, 5 year. So I'm saying, and this is not going to be parallel. So if I'm saying, if I change it by 1%, let's say, if I change it by 1%, it does not have to be necessarily changing by in a parallel movement, is what it says, because we are focusing on a non-parallel movement now. Now we are saying it can change by different amount. So now it can be like this, or any matter for that. It can be going like this and this as well. So we don't know. But the point here is it can have any kind of a non-parallel shape as well now. So when we talk about these factors, 1, 2, 3, 4, interest rate being the first one, the rate maturity that is given, like 1, 2, 3, and 5 are talking about the impact or the tenure which is associated with the securities. Now, if we talk about 1% change in factor number one, we are saying in a 1 year, this portfolio is going to have a minus 17% impact, in 2 year minus 29%, in 3 year minus 35%, in 4 year minus 43%. And For factor 2, if factor 2 is moved up by 1%, it's going to increase the value by 33%, 42%, 47%, and 17%. If I move factor 3 by 1%, that's going to change uh, year 1 kind of exposure by 70%, year 2 kind of exposure by 12, third 10, and minus 32. And this is more resonate to the line that you see here, right? Just to make things in sync, I'll say, for an example, how to interpret the table. I'll use this as well, how to interpret that table. It says, when there is a 1 unit change in factor 3, that means it rises by 1%. For our example, let's just take it 1% change. The factor, the 2-year rates change by factor 3. Okay, the 2-year rates change by 1.24%, right? He's talking about 1% change. So it talks about 12.4% basis point, which is 0.124 basis point, and a 3-year rate changes and it changes by 103 basis point. Positive factor of 1 this drive all associated factors lower, while negative units of factor 1 would drive all associated factors higher. Change on any given day is a byproduct of linear combination of these factors. So now I've used not the absolute numbers here, I've used them in a percentage term so that things become more easy for everyone to understand and not like on a very dicey level. I've made them look more like a percentage terms. Okay. And in fact, it should be 0.01 for that matter. 1% is fine, I guess. Okay. So this is what we mean. Now, let's come back to the factor scores. Okay, so by portfolio value change, what it means is if there is a 1% change with factor 1, we are going to have $10 impact. With factor 2, we are going to have minus $20 impact. Factor 3, we are going to have minus $30 impact. Don't worry how I got these figures. These are already there in the example itself. Now, what I need to do is for these factors, like interest rate being one, let's say unemployment being another, inflation, and some other policy, some other thing being the stock market performance being factor number 4. By saying that if I track these factors, they'll have their own standard deviation and variance. But because we are using PCA, all of these factors will have zero correlation, almost assumed zero correlation amongst all of the other factors. So that's where when we talk about standard deviation of factor 1, we got these factor 2, this factor 3, factor 4, variance in a similar way is this. And once we talk about the variance here, and now we want to talk about how much of the variance, like the overall portfolio variance may kitna is contributed by the first factor. That's where we get to know 80% of this. 80% of this is actually coming from the first factor alone, which is the interest rate usually. Okay, which is 80.13 is the most dominant factor here. When we talk about covariances, because we have used the PCA, principal component analysis, which distills down things into uncorrelated set of factors, that is where covariance variance matrix has 167.96 here, because this is the variance. The second variance is 33.87. Third is 4.58. Within the covariances, you see 0 because there is no relationship amongst themselves. By using this information, what we get is a portfolio standard deviation, portfolio variance of this, wherein we have included only A square, B square, C square, and not included anything which is portfolio standard deviation. Now, let me explain this to you a little bit more. How do you calculate for the variance of a portfolio if there are three things, if there are three factors? So of course there are weight of A, standard deviation A, plus weight of B, standard deviation B, plus weight of C, standard deviation C, and whole square. This is what I'm talking about. Weight of A square, standard deviation A square, weight of B square, standard deviation B square, weight of C square, standard deviation C square. This thing is common. And then we start talking about two covariance. Two covariance, A and B, standard deviation A, standard deviation B, plus two covariance, B and C, standard deviation A, standard deviation C. Sorry, and weight of A, weight of B, weight of A, weight of C, and two covariance, sorry, B and C. This is A and C. So standard deviation A and standard deviation C. Weight of A and weight of C. Now in this part, to calculate for the variance, we have this formula. But these three parts, because the covariance amongst all of these factors because of the PCA technique turns out to be zero, we just strike it off. And the formula reduces to this one. So that is where you can see only three things being multiplied here. Only this being multiplied here, C17, which is C17 into C13 square, right? C17 into C13 square. That is where we have taken D, that is the portfolio, that is the amount, because we want to get the portfolio variance as a dollar term. So what you get is a dollar term. Let me use dollar term variance in this. This is essentially dollar. Let me use currency number dollar. Okay, what we get is a portfolio standard deviation, but in a dollar term, right? This is a portfolio standard deviation. What this is the variance. This is the variance of factors, right? But this is for a portfolio. We're talking about 185.65. Here you see this is 209.62 is the total factor variances, and the total portfolio standard deviation will turn out to be 185.65. Hope that makes sense. So the point here is we are saying that our entire portfolio for fixed income is moved by a set of factors, interest rate being one, maybe other factors like inflation or unemployment or some other equity market performance being the other factors. And now we want to track everything in terms of factors, and we gauge, we create a matrix to find out how these factors impact each of the range of our securities maturing in a particular bucket, like 1 year, 3 year, 5 year, and um, 2 year, how they impact. Based out of that, we get a portfolio value change when we change a factor by 1 unit. Based out of that, we calculate for the standard deviation and variance, and we can also calculate for portfolio variance and portfolio standard deviation. Correct. Now, the point here is when we talked about these factors, we have broken down what is really the yield, right, or the partial 0 1. Similar to this, we can have a forward bucket 0 1, forward bucket 0 1. Let's just understand this point a little bit. Similar to key rate exposures, because we understand things are not moving parallelly. Now they are moving differently. Now you can have a situation. Now you can have a situation where your curve shifts like this suddenly, or you can have a situation where your curve shifts like this, right? This is all possible because these are not, we are allowing for non-parallel shifts as well, right? But we also understand sometimes there are certain key rates on which the things change, right? All across the portfolios go for a parallel shift, and up and down is a kind of a wrong assumption, because even if the RBI comes up with monetary and fiscal policies, they change the interest rate on, mostly it is the short-term rates that they change, but they change the interest rate at a particular point, like 2 year security, 5 year security. Similar to the key rate exposures, partial 0 1 are used for measuring and hedging the risk in a swap portfolio, whereas partial 0 1s are derived from most liquid money market and swap security. And forward bucket is also used for the forward market to the change of yield curve. So similar to these, we have forward 0 1 and partial 0 1 as well. Now we come to the point where we discuss about key rates and what are the key rate shifts. Now similarly, when we talk about this curve, the original curve was this. The original curve was this. But what happened is at a certain point, we believe, let's say in 3 years, we believe the interest rate is going to be up, or it's going to be moved up by, let's say, 1 basis point. 1 basis point. Now, an important part here is, first of all, when it changes, it's something that you need to know that every curve has few determining points. Like, some points are more important than others, so we can't just consider every point to be more important. So if I were to break it down this curve, I would say there are three key rates point, or four key rate point. I can call them as 1 year, 3 year, 5 year, and probably 10 year. So by calling out these rates, and you'll have to identify the key rate, that is called as a key rates. Okay, you'll have to select it, you'll call it as a key rate, and then you want to find out what happens if you, let's say, um, push the yields up and down at that point. Remember, when it was happening, the parallel yield curve, you were charging, you were You were basically moving them up and down all throughout 1 year, 2 year, 3 year, 4 year, 5 year, 6 year, 7 year, 8 year, 9 year, all throughout. Now you're saying you just move that percentage yield up at a particular point. At a particular point. You're not moving it throughout. So you're landing into a situation like this, where if it's 3 years is the curve, it is impacting at the 3 year range. You're moving this point up by, let's say, 1 basis point. Okay. And that is what key rates are all about. So it says that if you raise, and let's say that the four key rates are there, then how it impacts other points like key rates. Okay, this is the point to be noted. So let me come back and show you something here. Okay. Mm, okay, let's look at this example. Let's look at this example. It says that the key rates have actually moved in 1 year. And now how they move in 1 year is not only are they impacted at that particular point. Look at this. If I have a 3 year rate, if I have a 3 year rate here, if I have a 3 year rate here, let's say this one, this is a 3 year rate. So you can see that the impact has actually started some time ago, where things have started rising from the point, and suddenly then there would be times when things are falling. So this 3 year impact is only, let's say, 1% impact at this point of time. But by the time it reaches 2 year, or by the time it reaches 5 year, there is some impact which has started to be realized in proportion. Okay. तो थोड़ा बहुत उठना शुरू हो जाता है वहां से, because it's not a line, like ऐसा नहीं है कर्व ऐसा और एक पॉइंट बढ़ गया, ऐसा नहीं है, उससे पहले ये क्या बना है, एक हट टाइप बन रहा है. सो एट सम पॉइंट ऑफ टाइम इट विल स्टार्ट राइजिंग एंड देन इट विल फॉल. राइट. नाउ coming back to this example where you have four securities, the portfolio weightage of these is given. Let's say there is a security one which is expiring in 1 year. There's a 1% increase, and that's where we are talking about a 1% increase. Right. Now the key rate shift that we see here, key rate shift is in the 1 year range. Okay, sorry, it's in the, yeah, it's in the 1 year range. So all you see is here that the KR01, which is the key rate 01, is that it looks like this. But when it comes to the 3 year range, which is impacting in the 3 year range itself, it says that the impact is going to be, sorry, yeah, in the 3 year range, I have not constructed. I think this is 5 year. This is a 5 year curve, 5 year curve. So when it comes to, let's say, 5 year, let's say it comes to 5 year, that is where we are saying that the total percentage change is going to be 1% in 1 year, in 5 year, and again in 15 year. 1 year, 5 year, and 15 year, it's going to be, or yeah, in 15 year, it's going to be 1%. So exactly you can see this is 1%, this is 1%, and this is 1%. But the thing is, they don't rise on their own. There is a series in which they started to rise, right? The series or the trend is by the 5 years, if they want to reach to one, by the time they reach 3 years, there should be some kind of momentum to go up, and then there should be a momentum to go down. Similarly, there should be a momentum here. And then if you talk about all these changes together, because they're considered key rate, key descriptors, key rates, that is where they're called as key rates. So if you talk about talk about all the key rates having a shift together, all the key rates having shift together by, let's say, 1%. Now it will start reflecting the behavior of a duration. Why? If I'm saying curve में 4 points ज़्यादा important है, वो चारों ही points मैंने एक 1% से एक साथ बढ़ा दिए, then it would look like the overall curve has shifted by 1% parallelly. Okay, that is where we say that the key rate 01 is nothing different than dv01. So dv01 talks about what would be the change with the 1 basis point change if the overall curve shifts. If the overall curve shifts, whereas in KR01, at the key rates, at all key rates, at sum of all the key rates is where we are talking about things being changed. Let's say here, let's say here, let's say here, so on and so forth. So all the key rates combined together will give you a parallel kind of a shift impact. Okay, key rate shift. So that's where they say the most common key rates used for the US Treasury and related markets are par value bonds, which is -2, -5, 10, and 3-year par yields, which are called as the key rate shifts. The key rate shift technique is an approach to non-parallel shift in the yield curve, which allows for changes on all rates to be determined by changes from selected key rates. Key rates are a combination of rates closest to them. Key rates are mostly affected by closest key rate. 5 साल में change कर रहा हूँ, 3 साल वाला भी impact होगा, 7 साल वाला भी impact होगा. Effects are smooth. They don't jump abruptly. There is a smooth change. And the sum of all the key rate shift results in a parallel curve. यानी अगर मैं 3 year भी change कर दिया, 1 year भी change कर दिया, 5 year भी change कर दिया, 7 year भी change कर दिया, तो what I'll get is a parallel movement. What I'll get is a parallel movement, and this KR, key rate shifts, are an important topic to be understood. Key rate shifts, that is where we start talking about this one. If we are talking about that, if the key rates are, there are 3 key rates. We are analyzing the situation across 15-year timeline, and we are seeing the key rates are 1 year, 3 year, and 10 year. And within 1 year, 3 year, and 10 year, I'm changing this proportion. 1 year, and then in the 3 year, it is effectively one percentage pips, but it's changing smoothly. Then it's 5 year, it's one because there is no impact. Then 15 year, it's again going to be one. So overall, my portfolio, if I change all of this, I can see that in a 1 year change. mm, Yeah, with the 1 year change, the total change that I have seen for all the KRDs is 2412.9. 2412.9. If I change it across 1% for everything, like security A, security B, 3 year wale maybe, 5 year wale maybe, 9 year wale maybe, 15 year wale maybe, I get 2419. But if I change the key rate shifts for all these KR ones, I get 2412.90. The point here being, अगर key rate सारे के सारे change कर दूं, तो that would be a parallel. That would reflect like a parallel change in the yield curves, which is reflected here. So there is 1% here. Then you see this is 1%, then this is 0.75, 0.53, and then it goes down, right? Because it starts from 1%, but then it kind of goes below. When it comes to 3 year bond, when we want ultimately the 3 year bond to have like the highest price, or a 5 year one to have the highest price, that is where it's slowly rising to this point, and then it slowly falls after that. Once you want it to be 10, that is where we go to the 10, and that is where it's stagnant. And effectively, when we combine all of these movements, what do we get is a 1% change, or the shift in the yield curve, effectively, is what it means to say. Now, this is effectively what we have been talking about: key rate exposures and hedging. So this chapter on modeling non-parallel term structure and shifts and hedging was what we were discussing. So we have discussed partially this portion, and then we started discussing key rate and key rate duration. Now, let me tell you something about key rates and the key rates duration. First of all, so key rates is about that when you are not moving your curve fully parallelly, right? That means your curve can move something like this. This was what we discussed for the key rate 01, right? The only difference, and now let me try to connect the two terms that you'll be studying in this chapter. One is called as key rate duration, and another one is called as key rate 01. Now, the first thing that we need to notice when we talked about key rate 01, we said if the sum of all the key rates, and that we have to identify what are the key rates, sum of all the key rates, if they are increased by 1 basis point, they would exactly look like DV01. That is a parallel shift in the curve. Similarly, and just remember, KR01 is a corresponding term to TV01, which is dollar value basis point. And key rate 01 is a similar way, is another term that I'm introducing right now, but key rate duration is a similar term to duration, right? Now just think of outer difference. Now keep both these things in mind. Duration is a change in the bond value once the yield change by 1%, right? And this is the change in value when the um, when the yield changes by 1 basis point. Correct? Now, if these are all parallel changes that we have been talking about. But when we talk about non-parallel changes, non-parallel changes, that is where we talk about key rate duration. So key rate duration means the change in the bond price because that 1% change has happened in a non-parallel fashion on one key rate. On one key rate. Similarly, key rate 01 is the change in the price of a bond when the 1 basis point change happened on one key rate, right? That is the only difference between the key rates and the duration. But remember, be it key rate duration, if sum of all the key rates durations for any security would be equal to the duration for a bond, that means non-parallel shifts equal. If I've summed up them, they will be equal to the duration. And if I've summed up the KR01s for all the key rates identified, they will be equal to DV01. That's one thing to keep in mind. Now, does that mean that the formulas that we did for the duration and DV01 are they going to be changed? So if the formula for duration goes, we discussed that duration is equal to, which is minus duration by the way, bond price multiplied by change in bond price multiplied by change in yield. This was the formula we did it for duration. And for DV01, the formula that we did was if this duration is multiplied by BP is multiplied by 0.0001, right? Which is change in bond price by change in yield multiplied by 0.000, sorry, 0.00, yeah, 01, right? So this was what we have understood about the duration and the DV01. The formula does not change at all, interestingly, when we talk about this. All we need to change is we will start calling this as ARD, right? And the bond prices will have an impact of the 1 basis point change. This change of basis point and change in yield will track around 1% change on the key rate, not a parallel shift in curve. Similarly, this whole side I'm counting it as KR01, KR01, when the change in bond prices is with an impact of 1 basis point change by the change in yield multiplied by 0.0001, right? And I'm going to demonstrate it to you by the end of this chapter with an Excel that why are we talking about duration and DV01s to be equal to the duration. Now, for an understanding on that, um, okay. So think of it this way. What is a KR01? If I were to change the yields, no, I see that here. Okay. Yeah. So if I have the coupon rate as 3% for the security and the coupon value being $30, and that's where I calculate the cash flow, that is where the initial cash flow looks like 688,039,4337, right? And these are the spot rates that go with it, which has been used for discounting here, right? If I make them a parallel shift in change, which is I'm increasing them by 1 basis point throughout. That means what are the changes? The initial spot rates were 2%, 4%, 6%, 9%, and 12%. So all of them have been used like 2%, 4, 6, 9, 12. Now I'm increasing them by 0.01%, which is 1 basis point, which is the condition like this. Now, if I use the same cash flows with this discounting rate 2.01, 4.01, 6.01, 9.01, 12.01, the impact is going to be 687.755. That means if I increase the yield, I know the coupon rate is going to fall. But how much? Which is 688, which is the initial bond figure with 2, 4, 6, 9, 12 against 687.7555, which is 2.01, 4.01, 6.01, 9.01, and 12.01. So the change in price exactly that happened because of this is 0.0289. Sorry, the exact difference is going to be this 0.08, which is reflecting what? If you remember, which is reflecting my change in the bond price by the change in the yield. The change in yield is 0.0001, which is 1 basis point change here multiplied by the same change up. And that's where we get the figure 0.028399, right? The point to be noted here is if we want to bump this at 1 point, right? If we want to bump it at 1 point, then what happens, right? Here we have done it for throughout. Here we have done it for all the points, right? So overall, this is my DV01. This is my DV01 because I've increased this whole portion for the complete thing. Now let's see what happens if we do it for one at one of the place. So the spot rate has now increased to 6.01, which is now that I am moving one of my key rate. My key rate here is 6.01, right? With that, with those kind of cash flows discounting, which is 2, 4, 6.019 and 12, I get a rate which is 6.0883233198. Now look at this. Very, very rare difference. You can see it. But the difference is there. But the difference is there. So how do we calculate key rate 01? How do we calculate the key rate 01, which is going to be this, the initial answers minus the new answer divided by, again, the same thing. It is this difference that we have been tracking, F20 minus F10. When we come to this one, then it is 0.001 multiplied by this divided by this, which is exactly the same thing. And we get a KRD, which is this. Now, if we have to, the point here is if we take a KRD on 2, 4, 6, sorry, yeah, 2, 4, 6, 9, 12, whatever are the key rates that we decided, this sum total of all the KRDs should sum up to, sum of all the KR01s should sum up to the DV01. Sum of all the KRDs should sum up to the duration. It should sum up to the duration of this particular bond. Okay, this is the point that we want to make. The formula itself is not different. Some people teach KR01s and DV01s differently, but my point is duration is only for parallel shifts and DV01 is only for parallel shift. KRD and KR01s are the same things being talked about from a non-parallel perspective, which happens only at one point, which only happens at one point. Let's see. Yeah, KR01 and KRDs. So the exact same formulas can be done. Here you see the formulas, different formulas being treated differently. I would request you please keep these handy while you study this particular calculation or any calculation for that matter in this chapter and the last chapter, because as I said, they're written by different writers, so different writers have used different methods. KR exposures and key rate exposures and hedging. Now, once we have found out, this is the exposure you want to hedge. That means this is the downfall on your portfolio that you are going to see. Now you want to hedge for it, right? So you are saying the interest rate has risen only at one point and there is some kind of impact in the bond and you want to hedge yourself against that risk for 1 basis point up or down, whatever it is, right? You want to hedge yourself against that. So how do you do that? First of all, you will find out if there is a 1% change or 1 basis point change, what is going to be the impact on the portfolio, which is given as 48.75, 302.65, 595.10, 856.45, and then you can see that the key the rate shifts are at 1 year, 3 year, and 10 year, which impacts to 1. And then you do the calculation. So first of all, you want to find out, first of all, to hedge, what is the exposure that needs to be hedged. So there are 2 points to this section. One says, how do you find out the exposure that you should hedge, right? I think which lasts till this topic, this one. 57.6, till about 757.6. You're trying to find out an answer exposure that you should be hedging. And the next part is about how many instruments you need to add to hedge. So how many instruments or how many hedging instruments or how many hedges you need to add to get the portfolio hedged. So this is basically the long and short story of it. There are certain calculations. Let me try to explain the same concept with one of the thing that we have already done. So let's say my portfolio is an equal weighted portfolio of 20% each, and the individual securities 1 year, 3 year, 5 year, 9 year, and 15 year. So let's think of it. I have 5 securities in my portfolio, all invested in 5 year. One security of 20% is getting matured in 1 year. The second security is getting matured in 3 year, third security in 5 year, fourth security in 9 year, and fifth security in 15 year. And all 5 securities have a same weightage in my portfolio, which is 20% each. Now, the point that we want to make is if I increase this by 1% security A, The impact that I have right now is 95.62, right? Because I'm just changing my one key rate here at 1%. Similarly, if I do it for a 3-year period at 1%, what do I get? When 270.26. If I do the same security, like the third security for a 5-year, if I just change that particular rate, like the key rate for that year is 1% increase is 424.35. D is, if I do a 1% increase with that is 677.93. With E, it's going to be 1% increase is 1944.74. And I got the total portfolio exposure that I need to hedge is 2412.90. Remember, if I have taken all of these as a key rates, right? What do I get? What do I get? It also is a 1% increase. So we can also call it as a duration, right? These are the key rate durations, but this is a duration number. These are the key rate durations, but this is the final duration number, right? Correct? But duration is a number. It's not a dollar amount per se. So that's where it might be wrong to say. But yeah, this is the duration impact. Like I would call it duration into bond price is what you get. Duration into bond price, which is 2412.90. Now we want to understand out of all of this thing, how can you hedge? How can you hedge for these things, right? So this is the first part of it, which basically talks about the portfolio change that has happened. Now you want to understand of all the things that you have got right now, 95.6 to 272, 270.6 to 424.6. These things were done individually. Now you want to find out in 1 year, if a change happens, how it impacts different years as well, how it impacts different year as well. So if we talk about, let's say, key rate 01 for 1 year, 3 year, and 10 year, these are the three rates that we have taken: 1 year, 3 year, and 10 year is what we have been um, talking about now. So we take these three key rates. Then we want to understand that once we change the 1 year key rate, then a 3 year key rate is also getting impacted. Once we talk about, let's say, this should actually be at least 1 year, 3 year, 10 year, or 1 year. Yeah. So this is if we have changed it to the key rate 3 year, that is where 5 year is also getting impacted. 3 year, 5 year, and 9 year. Up to 9 year, it is getting impacted. Similarly, for key rate 10, there is zero point 0.8 and zero point 0.1, which is getting impacted. So think of it. If there is a key rate shift in 1 year, 1 year and 3 year gets impacted. In a 3 year, 3 year, 5 year, and 9 year gets impacted. In a 10 year, 9 year and 15 year also gets impacted, and that is where you look these curves look like this, saying this is going to be the impact. Now the point that we have here is how much of this is getting impacted. So if we are talking about 95.62, 95.62 overall, so this 1% 1 year change, how is it going to impact this security A, and all the other securities that we have? So we have 5 securities, A, B, C, D, E, which are maturing in different periods. So we have 1, 3, 5, 9, 15, and we want to find out the exposure change, which is there 95.62 into 1. So that means if the key rate 01 is actually moved by 1%, right, it is going to impact 95.62 in a 1 year security, but it's also going to impact 180.02, which is this figure 0.667 multiplied by 95, sorry, which is this figure 270.26 multiplied by the 3 year security. So this one, which has, this security of B, you want to understand how much of, or rather a better way to understand this is if we talk about 1 year is 95.62, then we talk about if a 1 year change is impacted, nothing is getting impacted in 3 year and 10 year. If we talk about 3 year kind of uh, an impact, that is where we see that in the 3 year security, which is this security B, if 1% is changed, when 270.26 is getting allocated here. In the third year security, it is getting allocated. In the fifth year, in the D security 677, it's getting impacted here in different proportions. 944, it's getting impacted here. And the total close that we have is still 2412.9. The point here being, you want to take all these risks with the 1% kind of a shifts, and then you want to allocate them to a different buckets of KR01, KR0, KR01, KR03, and KR10. इन अ वे जस्ट अंडरस्टैंड इट, आपके पास एक सिक्योरिटी के 5 ड्यूरेशंस दिए, 5 KRDs दिए हुए थे, राइट? 5 KRDs दिए हुए थे, आप उस KRDs को 3 KRDs में बांट रहे हो, Just think of it this way. You were given KRDs for 5 different periods, for 5 different securities. You are trying to break them down into 3 periods. You are trying to reallocate them. Think of it this way. You're trying to reallocate them, a 5 period KRDs into 3 year KRDs by putting different proportions to it. So that is where you're saying अगर 1 year impact होता है तो now 1 year से ये impact होगा और ये भी इतना ही impact होगा. 180.018 भी थोड़ा बहुत impact होगा. 3 से ये impact होगा तो ये भी impact होगा और बाकी सारे फिगर्स भी impact होंगे. तो ओवरऑल रिस्क को आप reallocate करो 5 सिक्योरिटीज के बदले में या 5 KRDs के बदले में KR01 पे जो कि 3 में डिवाइडेड हो. ठीक है, दैट इज व्हाट वी वांट टू do, right? Now, once we have got this security, what do we do after that? That is the first part, that you have tried to suppress your figures into a 1 year, 3 year, and a 10 year spot rate, like, smaller spot rates. Now, that is the first part where you identified the risk associated with these 3 periods, 1 year, 3 period, and 10 year, which is $275, 650, and 1487.08, which has been mentioned here. Now you want to involve the hedging instrument. Now you want to find out how should I hedge for these instruments, and this is where it goes for a different ball game altogether. So there we say that the portfolio is of 68, and this question, believe me, till about 57.6 is a different section. From 57.7, it's a different section. So don't think these two examples are connected. So think of it this way: when we talk about this portfolio, now you have 3 KRs. Now you have 3 KRs. So this we are talking about here. Now we have 3 KRs, right? KR01, KR02, KR03. Let's say that the KR01 figure that you have is 68, KR02 figure that you have is 106, and this is 169, and you have a choice of 3 hedging instrument. Overall, what do you want? That when this portfolio loss, this is a portfolio loss actually, when this portfolio is combined with this hedge 1, right? Let me call it A, B, and C. When this is combined with 2 of B and when this is combined with 3 of C, this should give you a zero exposure. मतलब आपके losses cover हो जाने चाहिए, right? This is what we mean to say, right? Exactly what is here. Then we say 106 plus 3A plus 12B plus 4C is equal to 0. Then we have 169 plus 7A plus 1B plus 15C is equal to 0. And with this, we'll solve for the ABC part and we'll get our answer, which says to hedge this exposure, overall, what do you need is basically you need short positions in 2 for A bond, short position of 5 in second bond, and short position of 10 in the third bond. And yeah, these are basically quantities because these are durations. So here he is talking about the quantities. Short position will hedge your portfolio. So the point is, how do you work on a hedging exercise? How do you work on a hedging exercise? You first of all understand this. First of all, and in this case, I've started from the very beginning. In this case, he has given you the decrease in portfolio value automatically. But where we started it from, he said with the portfolio value decrease is going to be these. But these come out of what? 1% change in all the different securities, right? 1%, 1%, 1%, 1%, which are non-parallel individually. And that is where we are getting 2 for 1, 2. When we try to break this thing down into KR01s, which is key rate 01 with the 1 basis point change, right? Or 1% change rather, I should say. I can also call this KRD01s if that helps, right? I should actually write it 0.1 change, 0.1% increase rather. I should rather mention it as 0.01% increase, 0.01% increase is what I should write here. 0.01% increase, 0.01% increase, 0.01% increase, 0.01% increase, and 0.01% increase. So now this gives me y dv01, dv01 overall. This gives me my dv01, right? Now I'm trying to understand, sorry, my bad, with this example. Now I'm trying to dissect this 5 security portfolio with five things into three key rates, which is key rate for 1 year, 3 year, and 10 year. I'm trying to establish the impact here. And all this risk for 95, 270, 424, 677, 944, I'm trying to reallocate within those three brackets, 1, 3, and 10. After doing that, I will have to find out for the hedge security, which I can combine with these exposure. If it's 95.62, I want to combine them. I want to combine these with three different exposures so I get my loss covered, right? This one. So here you see that KR01 is 68. So in our case, it is 95 point, sorry, KR01 is 275.8. So I want to combine three securities. In our case, how will it work? I will say 275.8 plus the duration of, let's say, the same kind of bonds is 14A plus 2B and 3C. 2B and 3C is going to be 0. The second situation 650.01, 650.01 plus 3A12B 4C. 3A plus 12B plus 4C equal to 0. And the third situation that we have is 1487.08, 1487.08 plus 7A1B, 7A1B and 15C. All of this should come up to 0. Now, if we solve for these, you will get your answer. Can we expect this kind of question? I would say actually speaking, the chances are very, very rare for this kind of question to come. Or if even if they come, I believe they're not going to go beyond the 2-period hedge or hedge for two different things rather than three different things. Okay, so don't assume that they are going to go beyond 2 period. In fact, this is the same thing that we have done it in our last chapter also. We were using the durations there. If you remember, we were using the durations and convexities to hedge at different levels. But here we are doing it with two different hedges, which have their own KR numbers, right? Now we come to the concept which talks about the forward bucket and the volatility. Forward bucket and the volatility. This concept is explained not in very good way here. So I have a spreadsheet which I have created here for the same thing to explain the same concept. And the concept essentially talks about the fact that your forward bucket 01, which is nothing but a DV01 for that matter, is going to look like the duration, the forward bucket 01, which is nothing like KR01, sorry, DV01 is going to be the sum total of KR01s. Now, let's understand this point. Now remember, for this example, I am talking about forward rates, right? But even if I talk about spot rates, because spot rates say forward rate banta hai, so I'm in this case I'm just talking about forward rate, but the interpretation is going to be exactly the same for the spot rate as well. So here he's calling about forward rate, but if I change the header to spot rates and take these as a spot rates, I think the answer and everything is going to remain the same, except for the fact now I'm going to start calling it as DV01. Okay, that is where you need to pay attention. Now, what would happen is there is actually an example. Let's first start with an example. So I have taken 6 months bond, like 6 months maturity that I have taken. Like it's a 4.5% coupon bond, which is actually paying coupon every 6 months till about 3 years, which means 6 periods. The coupon that I'm getting is $2.25 every 6 months, and on the maturity, I'll get $100 bond. So the final price is this. If I have decided for a forward rates, which are going to look like this, these are the forward rates that I have. These are the forward rates that I have, right? Now, if I have the forward rates, this is the present value of the cash flow that I get, 102.824499. Okay. Now, believe me, why am I taking these as a raise to par? Because the forward rate itself, I've taken it as a straight line. Usually they are not, but I've taken them as a straight line just to keep things simple. So I say that if I use the present value of cash flow, I get the bonds valuation to be 102.824499. Right. Now what happens is, now I'll take three different scenarios where I'm going to, you know, divide the whole period of 1 year into two buckets, 2 year to two buckets, and 3 year to three bucket, third bucket. And with every year, I'm going to make a change where I'm going to give them an increase of 1 basis point across. Like when I say this as a 1 year, so this means my 0.05 or my point half of basis point is basically getting here and half of basis point is getting increased here. So initially my figure was 1.75. Now I'm getting 1.755 where I've added 1 basis point ka bhi aadha portion in this one and other portion in this one, keeping rest of the rates same. Now I use these new discounting rates to get the value where the answer changes to 102.8145. In a way, what has happened is only the KR key rates for these things have been changed, right? Key rates. Remember, with that being said, the new price is this. So if I go to forward rate bucket 01, which is KR01 type of thing, except now we are talking about the forward rate, not talking about the spot rate. So that's where I'm using the word forward bucket 01, and that is also given in the book. So that's where I'm sticking to it. But the formula would remain the same. That is change in bond price. Change in bond price by the change in yield multiplied by 0.0001. So change in bond price is this price minus this price, right? This price minus this price, which is this forward bucket 01, which is giving me my DV01 because of 1 basis point change. And when it comes to duration, I'm going to apply the formula for a duration here. And I get that the DV01 is 0.01 and the duration here is 0.9722. I do the similar exercise with bucket 2. For the year 2, I let the year 1 figures remain unchanged now. But for year 2, I split this half basis point to both the periods 1.5 year and 2 year completed. With that, I get a new price. I get another DV01, which is minus 0.0096. Then I do it similarly for the bucket 3, which is a 3 year period, that is 2.5 and 3 year period. I get a new bond price and a new forward price and a new duration to support that. Now the sum of all the forward bucket 01 is going to be 0.0287. Similarly, the sum of all the KR or the forward bucket durations is going to be 2.793. This is the most important conclusion that we have, right? Now let's try the same thing. Let's try the same thing if we were to split the half basis point increase all across in all tenures. If we do that, then the new bond price will be 102.795780. Now what is going to happen is now I'm going to find out what is this price minus this price to find out the key rate 01 or DV, sorry, not key rate, but DV01. If I do that, then I find out minus 0.0287 is a consistent number that I get for DV01. And for a duration I calculate out of this particular change is minus 2.793. So which makes it possible to say even if I have a parallel shift, this is reflecting what the parallel shift compared to this rate, what is this reflecting? A parallel shift of 0.5 basis point or half a basis point parallel shift up or down, right? This is reflecting. In fact, it is reflecting up. So when we are talking about parallel shift, which is reflecting your duration and DV01, these numbers are this. But if we do the same thing across a forward bucket, if we do the same thing across a forward bucket with the KRs, so I get minus 0.027 and minus 2.73793, which is exactly matching. So hence proving that the thing that we said about this one, that sum of all the key rate durations will sum up to the duration. All the key rate 01 will sum up to DV01. And similarly, I can say all the forward bucket 01s should be equal to forward bucket 01. Bucket 01. Sorry, all the forward bucket 01 should be equal to, what is the name I'm using here? Forward rate, forward bucket 01 is going to be equal to duration. Sorry, is going to be equal to duration 01. Forward bucket 01 is going to be equal to the duration 01, dv01. dv, let me clear here, is also going to be equal to dv01. I hope that makes sense, right? And then we go back to our initial example where we started talking about the multi-factor analysis, right? And this is where they have started doing a little bit of new twist turn. So when we came to factors, we said our portfolio looks like this. There are four securities in our portfolio, and they're impacted by various factors. The impact can be tracked like this. If you look at this, this is basically impacting. All the things are impacting differently to all the five factors, and that is where we say the portfolio changes $10, $20, and $30 overall out of this 1 year factor change. If I change only one factor by 1%, I'm going to see a $10 change in portfolio. Two factor, it's minus 20, and three factor is minus 30, so on and so forth. And then we calculated their covariance, etc. But when we calculate their portfolio variance, what we did is we always calculate the weight, right? When I wrote that, I think I wrote this as well. Yeah, the the weight multiplied by the standard deviation. So the weights here are considered to be the portfolio value. The weights here are considered to be the portfolio value. So you can see that there is this C17, which is this figure multiplied by C13, which is this figure portfolio weight. So this is $10 change, which you have seen is also used as a weight. $20, which is D13, is also used as a weight. And E13, which is also used as a weight here everywhere. So that's where you get the portfolio variance, which makes sense, right? Which is very, very logical. So this is what he wants to prove. And having said that, this actually completes our chapter. So if I were to summarize this whole chapter in a way as to how you should read it, I would say things are scattered, right? When he talks about the PCA component analysis, he talks about half of the chapter here till about factors, till about this topic 51A. Then he breaks down the thing. Then he talks about the same factor here, same continuation here in these two paragraphs with the same logic, right? Now, if we talk about the rest of the things, how our key rate shifts and key rate and key rate durations work, that is where they start talking about these things, which last till here. First of the thing is that how do you convert this whole change of 1% or 0.01% into from 5 period to 3 periods, and then how do you hedge it, and then the forward bucket itself is another discussion. So overall, the topic is around mostly three topics. If you know that KR01 is nothing but it's similar concept to DV01. If KRD is nothing but a similar concept to the duration 01. Hope that makes sense. With this, we have completed this particular chapter.